is for educational purposes only. All videos, presentations and writing are only for educational purposes and are not intended as investment advice. You can implement this while trading at your own risk. If you would like to learn and follow our videos, please subscribe.
Good evening, fellow traders. I'm Victor from Niger TradeWise. Now, today we're going to, I hope we all had a great weekend. Today we're going to be talking about three things. Firstly, we're going to be talking about broker regulation. Secondly, we're going to talk about the 2% rule that I emphasized in the last trade. And the third and the final thing we'll be talking about will be our trades that we'll be considering this week. Now, with that out of the way, let's get to the first one, that is broker regulation. Now, a lot of people get hit on with a lot of ads about how you can make money trading the international stock market, forex, or indices. Of course, most of us want to make money and we just jump at the offer right away. But one thing I would like to talk about is this: before you place your money with any broker, you should first of all check, is that broker registered and regulated in one of the regulatory zones? Because if you do not do this, you stand a chance of losing your hard-earned money. So most of the brokers, like I will be showing you now, they have their regulation at the bottom of the screen. So we click on, let's use Niger TradeWise. We're going to one of our partner brokers, which is FX. We come to the bottom of the screen, as you can see. Now here, as you can see here, it says FX Limited is an international business company with registration number this is, and is authorized, like I mentioned, and regulated by the International Financial Services Commission under license number this. So now this is a clear example that every time you go to a broker site, these are some of the things you should look out for. Don't just, okay, they're telling you, some tell you, of course we have different marketing schemes out there these days, but some promise you heaven and earth. But the first thing you should look at is that, are they registered and regulated by a regulatory body? Because if there's any challenge, this is one of the places whereby you can cry out that, okay, look, I had some interaction with this broker and they're not getting back at me. Now, with that out of the way, let's go to the second thing we're going to discuss, which is the 2% rule. Now, take for example, using the British pound USD, which will be one of our focus for this week. We are looking at how do we calculate the 2% rule. Now, the 2% rule using the pips, that's percentage in price, will be calculated. Let's look at this. So let's assume this is about 500 pips now, and we have an account of $1,000. 2% of that will be $20. We would assume that, for clarity's sake, this is about 500 pips. Now, to make it easy, we will look at it this way. When you have a lot of 0.01, $1 will be equivalent of 100 pips. Now, if we are to get how much $20 will be, we will now multiply 100 pips is equivalent to $1 on the 0.01 lot. Now, if we want to get how much we are going to risk for 2% on 500 pips, we will now say 400 pips multiplied by 0.05, which will give us the 5 there. 5 times 4 will give us 20. Now, if you have here 500 pips, that means we will take a lot size of 0.04. But if you have 400 pips here, we will then take 0.05. What you have to understand is that depending on the pips number, you have to calculate also your lot size. So like I mentioned earlier, very important, if you want to take a Q on the British pound USD or on the Euro USD, when you count on a 0.01 lot size, 100 pips is equivalent to $1. So that means if we say 0.02, it means that 100 pips is equivalent to $2. Now, this way you can now multiply it to get your actual pip rate. So now, like I mentioned, on $1,000, we are going to say that this is, for clarity's sake, let's say this is 500 pips. Now we would need to open a size of 0.04 to actually get a risk portion of $20, meaning that we want to short it. So if this is our entry, if this is our entry point, and then this should be our stop loss. Now we will then short it, take it down this way. Now the risk of $20 will be here, and then of course we do 2% to get back 6 or 10%. So there you have it. Now hope this is clear about the 2% rule. Now the final thing we're going to be focusing on today is our trades for this week. We have three potential trades we're looking at. We're looking at the British pound USD, the Australian dollar USD, and the New Zealand dollar USD. Now for the first trade, which is the British pound USD, we will be first of all looking to catch our trade, because we will be trading on the 4-hour chart. To get our entry, we will first look at the daily chart. Now from what we can see here, moving average is telling us that this has turned bearish, because two candles have already crossed down to down below the moving average, as we can see here. Now that we've confirmed this is bearish, we will now come back here to the 4-hour chart and look for a pullback, of course like a reversal, whereby there will be another resistance. Now the resistance, when there is a break point, when it goes up and comes back, let's say like this, on the assumption like we come in here, it pulls up and then it doesn't break up. So after, let's say this, after it breaks this candle, let's say here, we take our entry point, let's say at about here. Are you with me? Then we short it down. That's how we catch our entry. Now of course this should be perhaps, let's say this is our, let's say we're using this candlestick, this would be our 2% risk. So we'll have to do the calculation, of course, of how many pips we're going to use. It all depends on your account size. Now that is for the British pound USD. We go to the Australian dollar. Now it will be on the same assumptions. We first look at the daily chart. Of course, looking at it here, we can see that the candles are already below the moving average. Now why do we use the moving average? It's the moving average is the average of a couple of different days, and then we get these candlesticks. Now each one of the candlesticks here represents a day. So once we can see that this is now on a bearish part, meaning it's going down, we will now go back to a smaller time frame of the 4-hour chart. Now we come here, let's say the pullback is here again as usual, let's say here. Now if this is our stop loss and this is our entry point, we will have to calculate it that we do not risk more than 2%, and then we take our entry. Sometimes you might find very beautiful trades, but they are much more than the 2% rule. So I know it's a bit hard, but my own advice is I'll tell you to skip the trade, because if peradventure the trade goes against you, you are losing much more than 2%, and it's a lot harder to recover on those trades. Now the last and final trade is the New Zealand dollar against the US dollar. Of course, we'll look at the daily chart once again. Candles are bearish. Go to the 4-hour, look for an entry point. That's about here, let's say. Now when we get this entry point, we look for a good position, calculate our 2%, short it, put a stop loss, and take profit. Now these are our 3 trades for the week. Hope this was clear to you. If you have any questions or want to see more videos like this, please hit the subscribe button so that you will get to see any new videos we release. And to everyone here, I'm wishing you a great week ahead. I'm Victor, and you all have a great week. Bye.